Hi there, Etoro. It is the first week of May, and that means that instead of looking back at what moved the markets last week, I will do a performance review for the whole of April. Let's take a look. Right, starting with the numbers, it has been a brutal month, but also a pretty bad start to the year, looking at most stats. So the SP500 for the first 4 months of the year is down 13%. The NASDAQ 100 is down 21%. My portfolio is down 23%. The NASDAQ 100 has fallen into a bear market, which is a decline of more than 20% from its all-time highs for the second time. And the S&P 500 is back in correction territory for the second time this year. My head is covering the statement, but I'll read it out to you. So this has been the worst start to the year for the NASDAQ, and I forget if that's the NASDAQ 100 composite or both, ever. And it's the worst start to the US bond market ever. For those that watch the bond market, you will have seen that yields have been increasing. I'll talk about that in a moment. It's also the worst start to the year for the S&P 500 since 1950. So it's been very rough going, and it's been rough going for a while now. Although I do take some heart in the fact that it has been wearing on for a while, and just the size of it, right? This is quite a strong pullback in the markets. And there is no subsequent bull market unless you have something of a pullback, a bear market, or a correction that's sustained. And that's what we've been seeing. Just to show you how brutal it has been, so this is the FinViz heat map for the S&P 500, the 1 month view, not the 1 day view that you get by default. And you can see that there were very few places to hide. So the defensive stocks held up a bit, but not all of them. The view is that almost everything here is in the red, and you can see that it's definitely the technology stocks, or those in internet retail over here on the right, communication services, that have been hit hardest through the past month. What were some of the key events from April? Well, as I've just said and reiterated, there was an enormous equity sell-off over the month. Some days we saw declines across the board, not just in stocks, with just about all types of stocks selling off, but also in bonds, which is a fairly rare event. Yields on US bonds have been increasing, and different duration bonds have been increasing by different amounts, so the yield curve has started steepening again. Remember, when the yield curve starts to flatten and begins to invert, the market gets nervous that that's a signal of a coming recession, although it is a bit of a secondary indicator. And I think that this has been in response to the Federal Reserve's quantitative tightening plans. Remember that quantitative easing is where the Fed introduces additional liquidity into the system. At the beginning of the year, we heard that they were going to taper that, so they're going to slow down the amount of liquidity that they were going to introduce into the system. But now we've learned that not only have they been planning to slow down the amount of liquidity, they're now going to start withdrawing liquidity from the system, and at a pretty rapid clip too. Through April, we saw mixed earnings, but nothing that was too bad, actually. So we're still in the midst of earnings. Many companies still need to report, but notably we saw the FANGs reporting. I think Netflix was a pretty large surprise, but beyond that, I think amongst the big companies, we saw a few misses. We saw some weaker forecasts. We saw some decent growth, but actually I feel as though the earnings that we received tempered the negative response in the market. I think towards the mid to end of April, people were really worried that this was it. The market was toast. The stock market was feeling sick, and that we were going to go down much further than we subsequently did. I think that the earnings that we saw gave people a little bit of hope. Sure, things are slowing down, but there's still pockets of growth out there, and the slowdown isn't as large as people had expected in some areas. We also saw China grow even more dovish through the month, particularly towards the end of the month, and that meant that Chinese equities had a bit of a rally towards the end of April. What do I mean by dovish? So they're more accommodating when it comes to growth. They have signaled that they're going to start dialing back a little bit of what they've been doing through the past 2 years, the clampdowns in various different areas within their economy, but also that they're going to increase the amount of liquidity within their system. Headline inflation in the US came in at a whopping 8.5%. This is a big number. and the largest that we have seen in multiple decades. But there are a number of ways to measure inflation, and core CPI, which is a subset of headline inflation, is showing signs of reaching a top. An example of why we need to look at the things that make up the inflation number are energy prices, and oil prices have been soaring since the bottoms that we saw through 2020. I mean, the price of oil briefly went negative, right? And since energy and the price of oil have such a large effect on inflation, we need to keep an eye on those year-on-year changes. And so the year-on-year change from those very low numbers in 2020 was enormous. And this has had a big effect on headline inflation numbers. Now, that's not the only reason. Of course, there's the war in Ukraine and the isolation of Russia from the wider global economy have caused supply chain issues once again, just as those supply chains are beginning to heal and driven up the prices of certain commodities. But if the year-on-year growth in prices of things like oil and natural gas begin to moderate year-on-year, their effect on the headline inflation numbers will diminish, and I believe that's when we'll start seeing inflation topping out. Again, my head is covering the text on this, so I'll read it out, but US GDP growth turned negative. Now, this was an enormous surprise, and the market responded a bit strangely on the day. I don't know if anyone remembers. So stock markets turned negative for a while before rebounding quite strongly later in the day. And I think this is because of the details behind this. So just so you know, if the US or any country has a GDP growth that is negative, so that GDP is shrunk for 2 consecutive quarters, that is called a technical recession. And I'm sure the media will have a field day with that, as they did with the headline that GDP growth had turned negative. But it's important to look at the details. And I think the details are why the market changed direction part of the way through that trading session. So a quick primer on macroeconomics. GDP is made up of a number of different elements: gross domestic product. Part of those are domestic items within the economy. So, for example, people buying from other people within the US, but there are elements of import and export, so international trade, that are involved in that too. Domestic activity, the domestic activity component of GDP growth within the US was actually up quite a lot within the US. So consumers are spending a lot of money, businesses are investing a lot of money. And so the domestic market, the market within the country, was actually very, very strong. The reason that the number was negative was because the deficit on trade was just so enormous. So the US makes money from exporting things to other countries, and it loses money when it imports things from other countries. Now, the US has been importing so much more than it has been exporting, that the difference between those two numbers was, I think, over -3%. There are still lots of theories about why this has happened. Part of it might be that the dollar has been quite strong, but also that the US's recovery economically has been stronger than many other countries. So the participants within their economy have a bit more money to spend, and so there are more imports than exports. But whatever the reason, many economists think that this will not persist through several more quarters. Although we'll have to see what happens next quarter. Will the US enter a technical recession or not? April also saw some recovery in parts of supply chains around the world. So for example, in certain countries, there is a worry that they have hired too many truck drivers and they have too many trucks, and the prices of shipping things by truck is dropping dramatically. However, on the flip side, I'm not sure how many of you have seen those pictures of ships outside of ports in China that are unable to drop off and pick up items quickly enough because of the lockdowns in China, and the traffic jam there is the largest that it has ever been. I think this just emphasizes that the recovery of supply chains is going to be uneven. We might see certain types of services or products that recover quite soon from the supply chain issues that they've experienced over the last 2 or 3 years, whilst others are going to be stuck for a while yet. For example, I think Honda has decreased its revenue targets for the year just because it's still experiencing such a large chip shortage. And lastly, the travel picture is rapidly improving for a large part of the world. I think the recovery is still most advanced in some of the wealthier nations like the UK and the US, but some airlines are now saying that they expect booking numbers to be above 2019 levels through the rest of this year. Hotel stocks have been soaring, US hotel stocks in particular have been soaring through the first quarter of this year. One thing to note, though, is that the recovery will be strongest within the leisure space, so those people going on holiday versus those traveling for business. It looks as though people are less willing to travel for business and companies are less willing to sponsor business travel in the current climate, so it's probably going to be another year or two before we see those volumes recover once again. So I haven't made a lot of changes to the portfolio through April, so I added cash at the beginning of the month, and I'm still holding a decent portion of that cash. Nearly half of that cash is still sitting in my account. And the merger between Discovery and AT&T closed in April, so my Discovery stock was converted to Warner Brothers Discovery stock. Now, there was an issue in this conversion. Those of you that copy me might now have Warner Brothers Discovery stock outside of your copy of me. I have fixed the issue within my portfolio, so I sold my positions and rebought them. So your copy of me should be fine. If you do not want to hold the Warner Brothers Discovery stock that you've acquired outside of your copy, please close that position. I've also completely closed out my ASOS position. I've been a big bull in ASOS for the past 5 years, but there have been a few large things that have come to light over the last 2 to 3 quarters. First of all, the CEO that made the company great is out. The company is still looking for a replacement, and they may have found one, an ex-executive from Farfetch, but we'll see. But that's not the only challenge going on. First of all, the war in Ukraine creates several challenges for the business, not just in the amount of revenue that they're going to bring in, but also in the margin that they have, and the company's always had a challenge with margins. Inflation has gone much higher than anyone expected. Supply chain issues are still hitting their bottom line, so I think the company is going to be treading water probably for the next 2 years or so, and there are much better opportunities out there at the moment because the stock market has sold off so much. I also closed out a position, a momentum trade on ᴑᴜ. So this is not a position that I bought based on fundamentals. ᴑᴜ set up for a nice breakout, so I traded that a little bit, and I have added a few other big tech stock names to the portfolio, just taking advantage of the weakness that we saw in stock prices through April. In terms of my outlook for this month, so it's very difficult to say what could happen in a particular month, but the market does feel oversold in places, but it can stay that way for a while, in the same way that it can be overbought for a long time, you know, days, weeks, months, or even quarters. However, some value stocks are now starting to feel very expensive, and in some places they are even more expensive than high quality growth stocks. So by some measures, Coca-Cola is now more expensive than Google, even though Google is an enormous company growing faster than Coca-Cola is. The desire to rush to safety has been so strong that it's overridden any kind of rationality in that area. Coca-Cola is still a fantastic company, don't get me wrong, and the last earnings were very, very good, but so are Google's, and Google's got a good track record of being a fantastic quality business, and their forecast was still good. So rationally, Google's going to continue to be a stronger business in terms of growth than Coca-Cola, yet people are favoring Coca-Cola right now. Doesn't make sense, but that will change. The highly anticipated Fed hike is planned for tomorrow, so everyone thinks we're going to see a 0.5% increase, 50 basis points increase. And the analysts are, depending on who you talk to and where they look, they're anticipating 7 to 10 price hikes through this year. The sell-off that we've seen in stocks is in large part because of those anticipated hikes. If it emerges that there will be fewer hikes this year and that they'll be smaller than anticipated, the market will give something back. The UK is also likely to raise rates once again from 0.75% to 1%. I think that's on Thursday or Friday of this week. China's PMI is below 50%, so that's a sign that that economy is contracting or will contract in the near future. Now, because of China being so integrated to the world economy, does that mean that other PMIs are going to follow? So US PMI is still above 50, the economy is still growing, it has been dropping off. Will the Chinese PMI pull the US PMI below 50, which then signals the recession in the US, a coming recession in the US is not just technical, but actually it's fundamental too. I also think that we're going to see inflation continuing to slow and potentially even hitting a peak. I think Q2 we will see this happen unless some other outsized event happens. another war somewhere else in the world. And I also think that the price of natural gas is going to drop off. It's been on a bull run for quite a while now. The price levels that it's reached are insane, but we're seeing the signs that there's a build-up in inventory of natural gas in certain areas. But also the northern hemisphere is coming into a warmer part of the year where it needs a lot less natural gas. What often happens with commodities is that there is an enormous spike up and then it drops off sharply as the demand is eventually dealt with. Sometimes this plays out over months. It can also play out over weeks or days. All right, so, and is this the big one? I mean, April was an awful month for the stock market overall and for my portfolio. It's been an awful start to the year. Is this the big one? I don't know. No one else really knows. And when you're investing, you're dealing with probabilities. It doesn't feel as though this is the crash to end all crashes. But I also can't say where the next 10% move in the stock market is going to be. Is it going to be up or is it going to be down? I'm not sure. What I do know is that in the US, corporate earnings grow at roughly 8 or 9% per year. And so over 9 years, corporate earnings tend to double within the US. So even though I can't say which direction the next 10% move will be within the stock market or the duration in which it will happen, I know, roughly speaking, given history, the next doubling of the stock market value will, the S&P 500 in this case, will be over the next 10 years or so. And so if I'm patient and there isn't any cataclysmic event that ends all life on Earth, then as long as I am bought into high quality businesses, I should be able to exceed that return in the stock market. All right, that's it for my April review. I will speak to you soon. Have a good day. Goodbye.